Why do banks fail?
For many reasons, the majority of which fall into one of three broad categories. A run on deposits. Too many bad loans, assets that fall sharply in value. A mismatch between what the bank can earn on its assets, primarily loans, and what it has to pay on its liabilities, primarily deposits. What are the reasons for bank failures? Let's see, the 6 banks failed in the world due to various reasons. Reason.
3 Washington Mutual, largest bank failure, a poor housing market on the run on deposits in which customers withdrew $16.7 billion within 2 weeks. Silicon Valley Bank, SVB, effective federal funds rate change. The tech industry slowed and funding for startups became less available. More SVB customers needed to withdraw their money. Citizens Bank, significant loan losses. Huge Heartland Tri-State Bank, First Scam. Republic Bank, Signature Bank, high level of uninsured deposits. Its loan book and investment portfolio also became less valuable as the U.S. Federal Reserve Bank raised interest rates, hampering its chances of a capital raise. Or management. Bank management did not always heed FDIC examiner concerns, and was not always responsive or timely in addressing FDIC supervisory recommendations.
Run on deposits. It occurs when a large number of depositors, fearing that their bank will be unable to repay their deposits in full and on time, simultaneously try to withdraw their funds immediately. Perceived or actual weakness of a bank. In most cases, liquidity concerns, uncertainty and fear among the bank's clients. Fear turns into panic. Bank is forced to sell assets, often at a loss, to create liquidity. Insolvency collapse. Customers withdraw deposits. Mass withdrawals cause, worsen liquidity problems. Confidence falls further.
Too many bad loans arch assets that fall sharply in value. Bad loans reduce banks' profitability and limit their ability to issue new credit. Large volumes of bad loans can cause banks problems with their capital adequacy and, at worst, can lead to default. Impact of non-performing loans on banks. Financial stability, Marvith, 48 PA, Ein 1. Increased credit risk, 2. Capital adequacy concerns, 3. Negative market perception, 4. Profitability, 5. Liquidity, 6. Contagion risk, 7. Investor confidence, 8. Regulatory scrutiny.
A mismatch between what the bank can earn on its assets and what it has to pay on its liabilities. The most common cause of bank failure is when the value of the bank's assets falls below the market value of the bank's liabilities, which are the bank's obligations to creditors and depositors. This might happen because the bank loses too much on its investments. It's not always possible to predict when a bank will fail. What makes a good bad bank? Valuation. Clean and coherent meta-information on assets makes valuation easier. Prudent provisioning supports appropriate transfer pricing, which facilitates the asset sales and workouts. Asset types. More homogeneous WART makes of the portfolio of assets, the easier it is to manage and sell. Location. The better the local economic environment, the easier the assets sell. Good governance. Tailor-made and governance rules to ensure their independence and effectiveness. Adequate legal framework. Bad banks need be able to buy and sell problem loans within a reasonable time frame. Insolvent debtors need fair terms. Buyers need timely access to collateral. Manage acquired loans, supported by centralizing, pooling or outsourcing to skilled staff.
Thank you. Humnawak Belay 091 128 2620